So part of my research is basically, what is the role of cryptocurrency in asset management? How should wealth managers look at cryptocurrency? How should asset managers, how should banks handle this topic? Okay, so I only have 15 minutes, so I'm not going to go into full details of my research, but I'm just going to give a few results. Basically, cryptocurrencies have been around since 2009, and they represent different types of investment products. I mean, if you think about Bitcoin, basically what that is you're investing in a potential future money. So if it becomes money in the future and you buy it early on, then you can somehow gain from the appreciation and value of that currency. And this is appreciation in the real terms, so in terms of real purchasing power of Bitcoin. If you look at Ethereum, for example, you can kind of think of this as like the future of capital markets. So with an Ethereum token, ERC20 token, you can basically issue this to your investors, and your investors will in return give you either euros or Bitcoin, and then you can raise capital for your ideas. So you can think of this as maybe investing in a future stock market, something like this. Europe actually has a very unique position right now. So I regularly go to meetings with the Securities Exchange Commission in the US and the Federal Reserve in the US. I also go to Malta and talk to the regulators there and the banks there often. And Liechtenstein in particular and Switzerland are actually unique in the whole world, in the sense that the regulators are open to this technology, and so are the banks. And actually, Germany is actually doing a lot right now as well. So BaFin is actually becoming increasingly friendlier towards cryptocurrencies. And the Deutsche Börse in Frankfurt is also working on a private blockchain structure. So there's a lot of movement in this area. So I'm not going to go too much into detail on specifically the fund that I work for, but I'll just skip right to the main overview of cryptocurrencies. So basically, this is slightly outdated because now the market's gone down quite a bit, but in general, the market basically has only a few coins that have a market capitalization of over $1 billion. So market capitalization is basically just a traditional finance term that we take and apply to cryptocurrencies. So this is the number of shares outstanding times the price of each share. And this is important because if you work for a fund, you want to only invest in cryptocurrencies that are very liquid. Because what matters for investors is if they can close their position or not. So in 2008, basically everybody got stuck. They couldn't close their positions. And investors are very aware of this risk today. So they want to only invest in highly liquid cryptocurrencies. If you put this into context of other assets, other asset classes, this is crypto over here. It's minuscule. And actually, this dropped by about half since I made this slide. But in general, so the derivatives market is the largest asset class in the world, between 600 to 1,200 trillion. It's very hard to estimate the exact value of the derivatives market. Real estate, global bonds, global money. So this is euros, dollars, pounds, all of the currencies put together, stocks on all the stock markets, and gold at 8 trillion, excuse me. So cryptocurrency is still relatively very small, and for large investors, it's almost too small to consider as an actual investment, because it's just if a large investor moves $50 million into Bitcoin in one day, they actually move the price of Bitcoin. So in order to actually to execute a trade without moving the price, you have to spread it out over many days. And for investors, this isn't interesting. Large investors, they want to be able to enter and exit instantly without moving the market. This is just for people that are interested in financial numbers. This is just the correlation between Bitcoin and traditional asset classes. So in general, just to sum up this slide, and I'm happy to send them out to people later, but in general, Bitcoin's not correlated with other asset classes. And why does this matter? This matters because traditional finance theory, if you go back to read about Markowitz and mean variance optimization, basically what Markowitz argued is that if you add in assets to your portfolio that are not correlated with your portfolio, then you can reduce your overall risk. Because when certain assets go up, other assets will not move, or other assets will go down. Okay, so you can make hedged positions. You can also diversify, so that basically you're not investing all your eggs in one basket. This is a saying we have in the US. I'm not sure if you have it in German, but the idea is don't put all of your eggs in one basket. So Bitcoin is interesting, and cryptocurrencies in general are interesting from this perspective of diversification. However, still, they're not very liquid. Next, these are some bear markets. So right now, so this is the longest bear market that Bitcoin had. It lasted over 400 days. That's actually when I invested, unfortunately. So this was back in 2014 when I first invested. And then the market lost 60%, 60% within a month or two. So then it was a very tricky situation because I didn't know if I had invested in a pyramid scheme or in something with real value. So then I had to really start researching this topic. On the other hand, the bull markets have been phenomenal. So when the price of Bitcoin goes up, it goes up by hundreds of percent, thousands of percent, which is just unprecedented when you compare it to other asset classes. Okay, so what's interesting here? So just to give some overall perspective on what's going on. So basically, when you have a token, what you can do is you can give this token to anyone you want. So it's very easy to create tokens. You can go on YouTube, type create ERC20 token on Solidity, and it takes you about 6 minutes to create this token. And what you can do is you can give this token out to people, and they can give you fiat, euros, in exchange. And basically what this does is it allows you to raise capital for your ideas without going to the stock market and paying millions of dollars to underwriters and for licenses, right? So that's on the issuer's side. So small firms anywhere in the world can raise capital instantly and very cheaply. On the investor's side, they like it because now they can invest in any product, right? Because currently, right now, most products are for professional investors only. So this means you have to have a certain net worth, you have to have a certain career in finance, you have to have a lot of qualifications. So from the investor's perspective, ERC20 tokens are great because now you can invest in any product in the world, right? But then the question is this all legal? Can you actually just circumvent our current system of financial market authorities and regulations that exist in place? And there's the different countries are answering this in different ways. Okay, so basically what people are trying to do right now is they're trying to say, I have this token. I want to, for example, there's a hospital in Liechtenstein, and they actually want to raise capital to build the hospital by issuing people tokens. And basically the question is this a security? Do I have to get a normal prospectus approved by financial market authorities, etc.? And basically what's going on is you're seeing firms that want to issue tokens. They want to have the ability to ensure investors basic investors' rights that we have in our current legal system. But on the other hand, they want to have it for a lot cheaper than the current system. So they want to just make a token, make a white paper. They don't want to spend a bunch of money on lawyers and licenses and all that. So what's happening is countries are having to decide, should we recognize tokens as securities or not? This is basically the question. So Austria, the FMA in Austria, the financial market authorities in Austria, they approved the first securitized token in the European Union on Monday, so 2 days ago. So they're basically saying, we're going to recognize tokens as securities. If there's any fraud involved, you can take that firm to court in Austrian courts. Liechtenstein and Switzerland are saying basically the same thing. However, there hasn't been a first security that's been approved yet under this model. But they're basically saying the same thing. They're saying if you want to raise capital, you're welcome to do so with a token, and it's going to be cheaper and open to more investors. So if we think about these tokens as being like stocks, the stocks of the future, okay, so the SIX exchange in Zurich, the Börse here, also the Singapore Stock Exchange. They're all trying to figure out how do we tokenize our stock market. Okay, so how do we make sure that all of our stocks are traded on a blockchain structure? And there's many reasons for this. One reason is being transparent about settlement of the shares. So I can talk about that more in the break if anyone's interested. But for example, the DTCC in America that settles all the stock trades in America has had some problems in the past with fractional reserves of shares. So this transparency is desirable. And so the regulators are basically calling this a security, and also investors are looking at these as securities, and also the companies issuing these are looking at these as securities. So if I have to summarize, the main point is cryptocurrencies are beginning to look like securities. That's basically the direction we're going in. So just like shares in any company, except for you, instead of having a share of a stock like you normally would, you would now have a token that represents that right of ownership in the company. So what is my research about? My research is about what's the best strategy for making money in the cryptocurrency market, because I work at a Vermögensverwaltung. Okay, and there's different ways to look at this. Okay, so active strategies, you can basically branch them out into two main strategies. There's active and there's passive. Active is where you're actively choosing which cryptocurrencies to buy because you think you have superior knowledge in the market. Then there's passive, which is where you just try to buy everything in the market and hope that one of them wins, okay? There's different types of passive and active strategies. The one that I find the most interesting is what's called 1/N in the financial literature. Okay, so the idea here is that you go to the horse races, you see all the horses, you have $10 to bet with, 10 euros to bet with, and you have 10 horses available. So what you do with the 1/N strategy is you just take N as the number of horses, and you just divide that by how much you have to invest with. Okay, so if you have 10 euros and 10 horses, each horse gets €1. Okay, so that's the main idea. What's interesting about it is you don't need any quant background, you don't need any theory, you don't need any data analysis, you just randomize, okay? Now, if we have to think about what was the most successful strategy on the stock market out of all the strategies available, are there any guesses on what that would be? Like, I don't know, mean reversion strategies or high-frequency trading strategies or 1/N? Any guesses there on the most profitable strategy on the stock market, like the Deutsche Börse, for example? Stock picking? Yeah, well, that's what investors want, right? They want to feel like I picked the right stock. Like they won because they had the right knowledge. But normally, actually, studies show that 1/N is the most successful. Just taking the market, saying the market knows more than I know. So the market as a whole encompasses all investors, and it's really statistically unlikely that I beat them, okay? So I checked that with cryptocurrencies. Is it the case? Unfortunately, I'm running out of time, so I can't go into most of this presentation. But for example, I left out privacy coins for legal reasons. I left out coins that aren't very liquid. I left out coins that can't be stored securely, which, for example, the coins in Switzerland and Liechtenstein that are stored securely can also be insured. So there's insurance companies that will actually insure these coins from being hacked if they can be proven to be stored in cold storage. And then I also included transaction costs, and I did this in R. Don't have too much time here. But in general, what you find is that 1/N outperforms basically any strategy. When you look at the cryptocurrency market, looking at previous data, past history data. Now, of course, it's important to consider two things. One, the past history data is very short. And two, the past does not predict the future. Okay, so it doesn't mean this is the best strategy going forward, but it does mean that you know, there's probably a lot of similarities between the cryptocurrency market and our current stock market. More similarities than we probably notice right away. There's some numbers. Okay, and yeah, in general, if anybody has any questions on that, I'm happy to answer them in the break. Yeah, I think that's basically my presentation.
Okay.
Thanks.